Greetings from New York City. It's about almost 1 o'clock here on Friday, the 16th of July. Our presentation today, we've got a lot of ground to cover. We want to talk about the markets at mid-year and what the first half has brought. Talk about seasonality in the precious metals markets and what it means at this time of year. I have a concept called Treasury Truths, some of the issues about U.S. Treasury debt market. As with seasonality, there's some things going around, comments going around that are not necessarily accurate. And we'll talk a little bit about Treasury Truths going forward. And then I have a few final comments about fear and loathing in the precious metals markets. So that's the update. In terms of what's happened, you can see here, gold prices have had a mixed bag. And it's funny because we spent a lot of time with people telling us how gold prices are very low. Just this morning, I had a colleague talking about why it was that gold prices had not responded. And I said, well, gold prices reached a record level last August, and they've come off, but they're at $1,820, which is the price right when we're recording this. Gold prices are very high. They're higher than they've been at any time prior to late last year, the second half of 2020, by a wide margin. Well, with one little spike up in 2011 and 2012. So you still have high prices, but I guess it is critical to note that while the gold price peaked in August of 2020, it is not that high again. Silver prices on the right-hand side also peaked in 2020, in early August of 2020, came down, they moved sideways. You see one little spike up at the in the first quarter. We'll get back to that one in a bit, but basically it's been there. Now, there has been weakness over the course of July, not in the first couple of days, but after the last several days. We've seen gold prices come back down, and then they came back up a little bit. And silver prices have been sort of moving in a very narrow range of about 25.50 to 26.91 over the course of, well, really since the middle of June. So you're in a kind of a quiet period. And we've been a little bit worried about another leg down. But as July has proceeded, and now we're getting into the second half of July and we're moving toward the August COMEX delivery period, we are less concerned about that kind of decline. And in fact, over the last couple of days, we saw gold prices rise very sharply. Silver still hasn't been able to break above that 27 figure, but it hasn't broken down below the 25.50 either. We think the probability of that next spike down is reduced compared to where it was 2 weeks ago. And the probability that gold prices will rise over the next 2 weeks and silver might follow it have increased. One of the things that we've seen is stale bull liquidation across these markets. There are a lot of people who got very bullish in the June, July, August 2020 period. They listened to a lot of rhetoric about gold prices. The world's going to collapse, and the stock market's going to collapse, and the dollar is going to collapse, and the Treasury is going to collapse, and Biden's going to collapse, and the price of gold's going to $10,000. Same stuff that we've heard for decades. And there were a lot of people who came in and they were very bullish about it, gold and silver. 11 months down the road, it hasn't happened. Gold's strong, but it's not there. It's at $10,000. Silver hasn't broken above $30 really since early this year, and that was only very briefly. Hasn't gotten to 50, hasn't gotten to 100, hasn't gotten to 750, hasn't gotten to 1500, or any of those other things. So we've got some investors who have kind of gotten disenchanted and have been taking profits. And last month in June, we saw about 338,000 ounces of gold ETFs liquidated. And I think we saw about, if I remember, it's like 12 to 16 million ounces of silver ETFs liquidated. Some of that was just what we would call normal stable liquidation. Some of it was people who had been listening to the rhetoric about, how prices were going to skyrocket, and they've kind of come to terms with the idea that maybe they were listening to the wrong people, and they're a little disenchanted. And you have any number of stockbrokers who are saying, hey, we told you to stay in stocks. You got into precious metals. How's that working for you? Do you want to get back into stocks? Probably exactly wrong time to get into stocks because they're very top heavy. We're definitely telling our clients to take the opportunity of weaker prices right now to buy gold and silver. But you've had this stable liquidation. It probably is going to continue for a while. We do think that the prices consolidate in the second half of 2021 and much of 2022 before rising more forcefully beyond 2022. But we do think that there is a period of time now where the prices will consolidate and move only slightly higher on an overall basis with some downside risks on a shorter term basis. If you look, this chart is gold, silver, platinum, palladium indexed to 100 on the first trading day of January 2021. And you can see that platinum prices actually did pretty well. They've come off and they're back where they started in the last 3 weeks. Palladium prices have been the big star, and gold and silver have not done particularly well. You can see a spike up in silver prices when the silver squeeze was at its best. You can see it overlaps with a spike up in platinum. Gold prices actually were falling at the time. Palladium prices rose a little bit, but not all that much. But by and large, platinum and palladium have been the star performers in the second half of this year. And CPM Group came out with its Platinum Group Metals Yearbook. This week, we have a briefing that's about an hour and a half long on the internet, on YouTube, that you can find. And we do think that platinum and palladium have sterling futures. I want to talk a little bit about seasonality and what it means in the precious metals markets now. We've actually seen some people saying, well, seasonality is going to drive gold and silver prices up July and August. These are the 4 seasonalities: gold, silver, platinum, palladium. Let's say that, yeah, okay, July is the weakest month traditionally on average since 1992, and we use a seasonality calculation that weighs recent years more heavily than past years. So yes, from a seasonal perspective, July and August tend to be the weakest periods of time for gold prices. And then you tend to see prices increase into September, October, November. So that may well continue again. So you might see strength, you might expect seasonal strength, but you wouldn't be expecting it in July and August. That said, and I've mentioned this in previous videos, 2019 and 2020 saw this seasonality overruled, and July and August, actually July was a very strong month in 2019 and 2020 for specific events in those years that caused investors to come into the markets and buy a lot of gold and silver, driving the prices up in July. They fell back in August. So the seasonality can get overridden by specific events in a given time. In silver, August is the lowest, weakest month. Platinum and palladium tend to be weak in June, July, and August. There's an automotive industry changeover that occurs at this time as they move toward new model years. That has reduced over time as the auto industry has changed the way it sells cars and introduces new models. And then the greatest seasonal weakness is in October for both gold, platinum and palladium. So that's the seasonality. We do expect prices to strengthen in the final 3 or 4 months of this year for gold and silver. Platinum and palladium, we think that platinum prices have the potential to rise more And palladium, we think, will tread waters because it's already at record highs. I'm going to talk about Treasury Truths, and we're trying to figure out what to do with this. We have a number of topics that we'd like to talk about in terms of the U.S. Treasury debt market. Who really owns those internationally owned bonds? There's all this talk about the U.S. Treasury gold swaps. Yes, there was a gold swap in the late 1970s in which the Treasury actually swapped gold in. The Treasury was lending dollars to Portugal and took gold as collateral against that loan. And a lot of gold bugs will talk about how the U.S. Treasury swapped gold out. Actually, it was taking in the gold as collateral for a dollar loan. Tales from the Treasury's foreign exchange desk. I'll leave that for now. The plunge protection team. I'll expose it. Who it is, who's on it, what it does, its history. And a little bit of history before it was existed. And then federal debt versus national debt. And that's a topic that ought not to have come up, but it has. And we're not quite sure why it has. In some circles, in other circles, we understand why it has. So we've got these things, and I don't want to have a long lecture on it. So we're either going to make one video that's as succinct as possible, or we might do a series of videos, or we might drop in a couple things. I'll give you a couple flavors here, just right now. This is a chart, and unfortunately the color scales are not here. We're working to get the original up. Who really owns those foreign and international bond holdings? And that's this green sector right here in this market. You can't see it, but the green is foreign and international funds. And who really owns it? A lot of people think that it's central banks from other countries, but therein lies a mistake. If you look at treasuries, you can see $28 trillion of debt right now. Of that 28 trillion, the US government, various agencies like the VA pension fund and the Social Security fund and others have about 6 trillion of it. Now that's important, and I'll get back to that in a second when I'm talking about the difference between federal debt and national debt. But it's like if you have a 401k and you need to borrow money, you can actually borrow money against your retirement account. You can borrow money from that account as opposed to withdrawing it and paying taxes, and you can use that. If you go bankrupt and the bankruptcy court says, okay, who do you owe and what do you owe? You say, well, I owe my pension fund, in this case, 22% of my debt is held by my pension fund. The bankruptcy court says, yeah, you're not going to pay yourself back. So you just take that off. That's important to know because it's the difference between federal debt and national debt. The US has $28 trillion of debt, and that's bad. It's really, really bad. And it needs to be fixed and it needs to be solved. But you have to understand the problem before you can effectively fix it. 22% of that debt is owned by US government agencies. Another 10.8 trillion is held by the Federal Reserve Bank and banking system. Now, Federal Reserve banks and the Federal Reserve banking system are private banks that are the government's bank. And they are not a risk for saying to the US Treasury, hey, you guys are bankrupt, I want my $10 trillion. So right there, you've got 16 of that $28 trillion that you don't have to necessarily worry about demanding payments. That leaves about $11 trillion, which is still really bad. At the end of the Carter administration, we had less than $1 trillion in national debt, and it's exploded over that time. And of that rest, and here's an interesting kicker, $7 trillion is in what the Treasury calls foreign and international holdings. Now, a lot of people will talk about how the Chinese government has all of this US Treasury debt, and they could jump on the springboard and we all fall into the water or, fall off of the cliff if they wanted to do that. But the Chinese government has $440 billion of treasury debt. The Japanese government actually has the most of it, $1.3 trillion. And the UK government has more than China. And other governments have other amounts. But the thing about the foreign and international holdings is these governments report how much they have. Other people don't. And economists, mainstream economists who actually know what they're talking about, not the bugaboo, oh my God, the world's going to fall apart people, but actual people who understand finance and monetary policy and economics, figure that somewhere between 35% and 40% and maybe more of those international holdings are held by US individuals, corporations, and funds, including a lot of pension funds. $2.5 trillion, right? More than governments have in there. So that's the real risk. These are people who are holding their assets offshore, and they're holding them in US treasuries. They're holding them offshore because they don't pay taxes on the earnings of those assets. But if you're holding your assets offshore, you have currency risk. But if you're holding your offshore assets in US treasuries, you don't have currency risk. And there's about $2.5 trillion of debt that are held by these people and corporations. And these guys happen to be the largest contributors to campaigns for president, for senators, and for congressmen. And they say, as long as you don't do anything to try to cause us to pay tax on our offshore earnings, we'll hold it in treasuries. But if you try to change the tax code to make it more equitable and efficient and honest and ethical, you've got a real risk. And it's not the risk that the Chinese government's going to say, I'm going to sell my treasuries. It's us. That's an interesting one. So I've kind of gone through that. Here's the other one, federal debt versus national debt. I don't know why some people are talking about it. I know why other people are talking about it. They like to throw in all that other stuff that I just talked about, you know, the $6 trillion of US government-owned debt, the $10.8 trillion of Fed debt, but especially that $6.8 trillion. And they like to say, well, you know, people talk about the federal debt and how high it is, but they're not, they don't even have half the story, because there's all of this other debt that doesn't show up in the federal debt as reported. It's the national debt. But that goes back to what I was talking about, bankruptcy. If you owe yourself money, $6.8 trillion, do you really owe somebody that? Well, yes, you do, but how you deal with what you owe those people, your own pension fund, differs over time under different circumstances. Probably about 13 years ago, I was at a conference, gold bug conference. It was a gold conference that was overrun with gold bugs. And while I was there, the New York State government was having trouble selling a bond offering. And the announcement came out overnight that they had made an agreement that the bonds would be bought almost entirely by the pension funds of New York State employees. One of the gold bugs said, you know, this is it, this is the end. You know, they can't find anybody else to buy their bonds. I said, this is genius, because most of that debt that New York State has is to their unfunded pension funds. And those pension funds are very large because state employees get a lot better pay than most of the rest of us as workers. And here you are saying to these guys who you owe in the long run on your pension funds, hey, you're going to own the bonds. So if you jump on the springboard, you're shooting yourself in the foot. It wasn't the exacerbation of a problem to the end game where everything was going to collapse in terms of New York State financing. It was the solution. You're making your creditors be your debt holders too, so that they have a vested interest in making sure that you stay solvent. And when you want to make a point, oh my God, the debt's so much worse than it is, you throw in other things to make it, to talk about the national debt instead of the federal debt. Now, a final few comments. We've talked in recent months about, people selling gold and silver on to you. And these are just some of the headlines. And it's like the IMF soon will smash the US dollar. Well, no, it won't. Oh, the IMF is going to raid your bank accounts. And if you have more than $5,000 in the bank, they're going to take it. No, it's not the IMF, it's the Treasury. There's an imminent disaster. If you have more than $5,000 in your bank account, you better take it out right away. There's all this fear mongering. And that kicks back to what I was talking about with the stale bull liquidation that we've seen over the last month or so. It's not a good way to market precious metals if you're in precious metals for the long haul. And I've been in precious metals since 1978, so I'm playing the long game. But what you do, and you're seeing it now, is you're setting up investors to be disappointed. And you hear these old folks talk. Oh my God, the world hasn't collapsed. The Treasury hasn't collapsed. I've been hearing since 1981 that the Treasury bond market's going to collapse, and I've been waiting for it. What you do is you turn off mainstream investors, sentient investors, intelligent investors to precious metals. Precious metals have a very vital role in preserving people's wealth and also building people's wealth through capital appreciation opportunities. But it gets turned off in the minds of many investors because of the fear mongering that many marketing groups use. It's just not there. I was at J. Aron when we merged into Goldman Sachs in 1981. And Goldman Sachs said, a lot of our clients don't like gold, they don't buy gold. But we're buying J. Aron because we want to market gold to them. And what they found was that a lot of their clients actually were J. Aron clients, and we were selling them gold. And they would say, gee, I thought you were my friend, Charles, but here you are buying gold and you never told me. And the answer was, well, Goldman Sachs tells its investors that gold is for crazy people, and I didn't want you to think I was crazy, because yes, we're friends. And you found that over and over again. And you see that on the part of stock and bond marketing groups. They use the poor quality information of the fear mongers, or I sometimes call them carnival barkers or snake oil salesmen. They use all of that nonsense that these guys market with as an argument as to why legitimate, sensible, intelligent investors ought not to buy gold and silver. And one of the things that the gold and silver market has always lacked in my entire life is honest, intelligent marketing, effective marketing to investors. And it's still going on there. Now, people have been asking me, we had this unfortunate situation where Mike Maloney made a video about me, and his company, goldsilver.com, pulled the video as soon as they found out that it was there. People have asked me, why did they pull the video? There were all kinds of baseless rumors that we had threatened to sue them. You'd have to ask them why they pulled the video. I don't speak for them. CPM Group did not threaten to sue. If I may make a joke, threatening to sue people is a kind of a low-grade thing to do, and I just don't like low-grade behavior. We don't threaten people threaten to sue people. We just don't do that. We've sued a couple people, including Goldman Sachs, but that's because they asked us to. Literally, they said, sue us. So we did. In fact, goldsilver.com's management reached out to CPM Group after Mike Maloney made an earlier comment about us in late May, early June, and said, hey, he's going to issue a public apology at some point. So we waited. And then he came out with a thing that was not an apology. It was to say it's a screed is to diminish the meaning of the word screed. It was just really unfortunate what he did. And we said, well, if you're going to have an apology, maybe we'll even give you a peace offering. We'll offer some services to goldsilver.com's clients. Goldsilver.com declined that offer. They said that Maloney would apologize. He didn't exactly apologize. And they said that he would never mention CPM Group and me again in public forever. And we're going to see if they're good at their word. Why hasn't CPM Group responded? Any number of people have asked us about that. And the answer is that goldsilver.com asked us not to. They said, please don't elevate this thing and prolong it by talking about it, as I am doing right now. You're just prolonging the embarrassment for us and for you. I don't know that it's an embarrassment for me that somebody makes a bunch of misstatements and lies about me. It's offensive, but I don't know that it's an embarrassment for me. We said we will respond, but we'll do it in the proper time, proper place, and proper manner. And we think that this is the beginning of that proper time and place. We're going to focus not on anything personal. We're going to focus on Maloney's professional shortcomings. He made a lot of egregious misrepresentations about me in his video. And I want to clarify some. And people have said, Jeff, don't make this video. Don't bring this up in public. Just let it die. But when someone lies about me, I don't let it stand. One of the things he said was that we had attacked the Silver Screeds people initially, starting the bad blood between those folks and us. That's not true. CPM Group was monitoring them. I showed you that chart earlier with that little bit of spike up and then it was gone. We were monitoring them. We didn't think they would be very significant. They don't seem to have been so far. But they attacked us initially, unilaterally. We were attacked by these guys who were saying all kinds of things, inaccurate information. They didn't even know what a merchant was. They thought that producers and fabricators were trading on the COMEX directly. They were talking about how gold and silver, or silver could be squeezed to $100 by May or April or July. And we only responded after they were trashing us on their videos. If they had never trashed us, we would never have mentioned them because, as we said subsequently when people asked, they weren't very important to the market. Let me just go back and point that out. Here's the spike that they caused. One day, and here's the price subsequently, and you can compare the price subsequently with that of gold and platinum and palladium. They haven't done a very good job at driving the price of silver up the way they said that they could and would. But that doesn't matter to us. The only thing that matters to us is that they malignantly attacked us with inaccurate information and a great deal of personal venom. Doesn't fly well with me. And now we're getting death threats against my family and me. Let's just say that's not a high grade way to behave. Maloney and CPM also said that CPM Group was punishing Jeff Clark, who works with him at goldsilver.com. We've had an incredibly positive relationship with Jeff Clark and with goldsilver.com for years. And as Maloney has said, we have provided him a tremendous amounts of information, some of it free, some of it for cost, about the market. We helped him understand the market when he first came along. When he first said something nasty about me, I mentioned it to Jeff Clark, who regularly checks in with us and talks to us about the market. I said, Jeff, you know, we're being nice to goldsilver.com, and this is how your company treats us. Nothing personal, Jeff, but that's rude of the company, if not you personally. We made it clear in writing that we would not penalize Jeff Clark because of what Mike Maloney said about us. We put that in writing. We sent it to Jeff. We talked to him on the phone. We sent it to goldsilver.com, talked to them on the phone. Maloney was fully aware of it when he lied about it in his second video. So let's focus on his records. The really funny thing that he said was that Jeff Christian really knows the silver market and the gold market better than anybody else, but he doesn't understand the psychology of the market. Now, last week I showed you our silver returns, which are just stellar. A lot of you know that we have since 1980 been calling the ups and downs for silver and gold and platinum and copper and oil, with a very, very good track record. And that track record is predicated on our fundamental analysis, which includes understanding the psychology of the market. And Mike Maloney criticized me for not understanding the psychology of the market. This is the Mike Maloney that in May 2011, after the silver price had gone from $36 to $50 to $32, Mike said that silver would be within up to $1,500 in a very short time, and that gold would be $15,000. Then he doubled down and he said, you know, oh no, gold's going to $22,000, and you'll be able to buy a house with 10 or 100 ounces of silver within a few years. But don't take my word for it. These are some comments about Mike from people who used to follow him. Mike may know the psychology of the people that he tries to confirm their worst fears that the world's going to collapse and they better buy gold and silver. But we know the psychology of the other 99% of the market. And that's what gives us our track record. And you can see our track record by buying our Platinum Yearbook, which came out this week, or our Gold and Silver Yearbooks, or all three of them. You can sign up for our retail investor programs. And you can, if you're a client of CPM Group through the retail investment program or any other major services that we offer, you can participate in our open forums. The next one of which will be August 25th. It's a Wednesday, about 5 weeks from now, where we simply are there to answer questions and talk about issues that our clients want to hear about. That's all I have. A lot to digest. We'll see you soon, and we'll keep talking about those Treasury Truths and what's really going on in the real precious metals market and in the real economy. Have a good weekend. Stay cool, stay healthy, and be good to yourself and others.